Unrivaled investors. Earlier today, Crowdstrike stock dropped around 20% following their third quarter earnings results, causing investors to wonder, well, how bad was it? How low does Crowdstrike go? If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. If you enjoy educational investment videos, please make sure to hit that subscribe button. So let's understand what's going on with Crowdstrike. Well, first, you should know I actually did a video on Crowdstrike over a year ago, effectively saying, and this was at around $270 a share, I called out, yes, this is an exceptional company, but the assumptions you have to make to have a terrific return from here are just too high, and I couldn't see it. So I think this goes into another example in the huge file that says valuation matters, folks. So the question is now the valuation compelling? And so no matter how exceptional of a business you are, you need to pay a reasonable value in order to have attractive returns long term. And I called that out last year when it was at 270, saying, hey, I just don't see it. So quick recap on CrowdStrike. They're a pioneer of the cloud-native cybersecurity industry. They monitor millions of customer endpoints, laptops, desktops, servers, virtual machines, mobile phones, where they can learn from one customer's potential exposure or threat and can instantly update to protect their entire customer base, hence a crowdsourced security cloud solution. And when you look at endpoint detection and response, there's a lot of different players actually that are out there, yet they are viewed as the number one player, based on various different industry, reviewers like Forrester saying, hey, they're the chief player, and their data suggests this as well, as they're rapidly taking market share. That is what I want to see, folks. I want to find the companies that have that very strong value proposition. They might have a lot of competition, but their value proposition is so strong that they're just going to gobble up market share over time. So I want to see that, and that's what they've historically done, and it looks like they're continuing to do as they're growing at 50% plus. Not only are they a leader in the endpoint security market, but what you're looking at is them rolling out additional tools that then help accelerate their growth. On the most recent conference call, talking about how identity protection has been, a nice growth driver for them, another product to cross-sell. And so this results in having a huge addressable market where they layer on more and more products, log management, threat intelligence services, data protection. So they're saying, yeah, over time, talking about $100 billion end market that's growing at a mid-teens rate. And so if you're talking about a market that's growing at a teens rate and they're growing at 50% plus, you're definitely taking market share. Looking at their third quarter results, it's not like it was just, absolutely awful. That's not the case. I mean, look, their customers grew by 44%, 21,000 customers, many of the leading businesses of the world, 15 of the top 20 US banks. I mean, this is what I like to see, and they've rapidly scaled up their customer base. So they're no question delivering, and their customer stickiness remains really high. I mean, 98% gross retention. So they effectively lost 2% of their customer base, in the year. That's extremely sticky. Very few businesses have this type of gross retention. Net retention means their existing cohort of customers still managed to spend 24% more year over year. So their business would have increased closer to 24% without getting any new customers. So this is still doing really well. The problem is, so why is the stock getting crushed? Because the stock is down significantly. I think it was previously around $280, $300 a share. Now it's closer to 110, 120, around that figure. Well, what's going on here? It's due to concerns about recessionary headwinds. Well, management talks, look, there's a lot of positive trends we see in our business, including competitive win rates, high, i.e., hey, we're taking market share, saying consistent average selling prices, ASP. Like, hey, it's not like we're having to mark down our offerings. Like, we're doing fine. We have exceptional retention rates, which I just called out. This is mission critical nature of cybersecurity. So this is tailwinds that they have. Great industry, great business to be in. But they talked about increased macroeconomic headwinds that they saw in the quarter, resulting in net new annualized recurring revenue. So effectively net new business coming in below their expectations. And so they're saying organizations were starting to respond to this macroeconomic conditions by adding extra layers of required approvals and extending the time it takes to close some deals. The way to think about this is customers around the world right now are saying, okay, businesses around the world are saying, you know what, we got to clamp down on our expenses. There's a upcoming, we're not sure if it's a level 1 storm or if this is like a crazy hurricane recession that we're going to face. No one's really sure how bad or how deep it is. There's various different perspectives, but when you have that on the horizon, companies start tightening up. So that means laying off the fat, taking longer to approve new deals. And that's what you're seeing here, taking longer to approve, some of the deals that they're looking at. So that results in it becoming harder for them to land new business. So they say, we saw customers increasingly delay purchasing decisions. Yes, sales cycles lengthen, but they believe the vast majority of these deals are not lost, just delayed. Okay, so that's really the key thing you're going to want to be paying attention to is, hey, is someone else picking up these deals that they're losing? Because that would suggest their value proposition is under question. So far, I don't think that data point is realistic, given the fact that they're growing at 50% plus. And this is a sizable, $2 billion plus revenue business. So I view this as them actually starting to be hurt by the recessionary concerns. So as you think about, it's tougher for them to grow their new cohort of customers, they're saying, looking into fiscal 24, thinking about this sort of headwind, they're saying net new ARR would be roughly flat. So they're not able to grow the new cohort of customers that they'd sign up. So they would say that would imply low 30s%, effectively ending annualized recurring revenue growth rate. So talking about, let's say, mid 30s, low to mid 30% growth in fiscal 24. So their next fiscal year versus the 50% plus growth this year, that is a huge deceleration. And that is a big, big problem for this type of stock. That is what I've called out now for over a year. You can't have a ridiculously high valuation and then potentially have significant deceleration in your revenue. And no one knows when a business will go from 50% growth to 30% growth. No one can anticipate that. And that's the inherent risk when you pay 20 times, 30 times sales for a business. Right now, it's still trading at a mid to low teens sales multiple, not even earnings multiple, sales multiple, low teens earnings, low teens sales multiple. And that is just a real challenge when you have a business saying, hey, we're facing real deceleration, and who knows if it further decelerates from here. Okay, so what are my thoughts on, Crowdstrike? Where do I think it goes from here? First, quick plug. If you're looking to take charge of your investment journey, consider unrivaledinvesting.com for compelling investment ideas, real-time portfolio updates, and our exclusive Discord server available for annual subscribers. This is not financial advice. So I look at Crowdstrike, and overall, once again, they're winning. 60% of their customers have 5 or more of their different products. So they're successfully cross-selling. And based on management commentary, they're effectively saying, the contracts that we're winning from some major customers, major banks in the world, they're ripping out their legacy piecemeal solutions and they're putting in Crowdstrike and the multiple modules that they're able to sell. So this is a complete solution. They're taking share. They're winning. This is what I want to see with the business. Management still thinks that they're on track for $5 billion plus fiscal 26 revenue or annualized recurring revenue. I think that's going to be a bit trickier for them to deliver if indeed they're decelerating to 30%. So this is going to be one of these periods of like, hey, how long of a period are you stuck at a 30%, or maybe do you even go even lower? So does that mean they're going to have to scrap this target ahead? I think that $3 billion plus for fiscal 24 is off the table with 30% growth. So we'll see from here. That $3 billion plus. So this is part of the like, hey, you just put this out a few months ago in I think April. So now, Wall Street's going to say, we're not going to really trust your projections as much if all of a sudden these things are happening. Admittedly, it is a recessionary impact. So one should just say, hey, you can't predict the future. Let's just focus on delivering results and what we think the profit margins could be long term. And we'll talk about that in a second. Now, you might say, well, Daniel, this is a different business than a lot of companies that are high growth because they have real free cash flow. And management is quick to point that out, talking about positive adjusted operating margins, keyword being adjusted. And positive free cash flow. Look at our 30%. Free cash flow margin. Woo, $467 million in free cash flow. Folks, $374 million of that year to date is from stock-based compensation, and the rest comes from positive working capital. So, and I talk more about that dynamic of getting positive working capital in my new financial statement course, currently only available for Unrivaled Investing subscribers, but I'll plan on launching it later this month to the general public. But thinking about that free cash flow, like that's just not super impressive in my opinion. When you're saying, oh yeah, 500 million year to date free cash flow, but the vast majority of it still comes from diluting shareholders. Yeah, I mean, you're selling, you're expanding, you're diluting the pie effectively. So existing shareholders. So if you look at their growth rate, yeah, their growth rate's, 53%, but when you adjust for dilution, it's closer to 50%. And that challenge is going to become even more pronounced when you're closer to 30% growth, because if you keep up with this high dilution, your real actual growth rate on a per share basis, that is the value management needs to focus on. What is the per share value creation? And doing significant dilution each year just bothers the heck out of me. And you look at what management is guiding to, their target operating model. This shouldn't give you any comfort when they say, 30% plus free cash flow margin, 20 to 22% operating margin. This is their non-GAAP measures. Folks, they even disclose stock-based compensation. They're expecting to be mid-teens in fiscal 26. So they're effectively saying, yeah, our profit margin might be like low single digits in the next few years. They're not even projecting to get to real profitability in the next few years. So that is a point that, in my opinion, really reflects that management needs to wake up. And this is not just them. This is a lot of companies saying, hey, what is your per share value over time? Go back to Microsoft in the 90s, and you had a company generating real profits, 30% profit margins. I mean, that is what you want to see, with really strong growth for years ahead, where you're able to say, hey, I'm paying a reasonable multiple to earnings. Maybe I'm paying 30 times earnings and it's growing at 30%. This is still something where it's like, hey, you still need to get there, and they're not there. And they're saying, by the way, we're still not going to be there for years to come. And that, I think, in this environment, it actually warrants a discount versus everyone's, a hype 30%, 30% free cash flow margins. I look at this, I think given what management has said about stock-based compensation being, being mid-teens for years to come, that it's appropriate to use, different operating margins than, let's say 30% plus. I think 20 to 25%, that's the profit margin. I'm assuming this year that they're around 56%, 57% growth in total revenue this year. Still very strong. So the question is, well, what do they grow at over the next 5 years? Maybe I'm being a bit conservative here. We'll see. I'm saying 25 to 30% annualized growth from here, getting from a $2 billion revenue business to a $7 to $8 billion revenue business. But look, folks, it's still a company that's trading at around 12 times sales, even after it's fallen to $112 a share. So I look at this and I'm thinking this is still not dirt cheap. So the question of how low does it go? I don't think that you do not get the deep value investors to step up until you're seeing a sales multiple that's, let's say, closer to 5 times, closer to 6 times. When you're looking at a sales multiple closer to that, so I think you still have significant pressure to go. I think maybe you're looking at like $80 a share. I think below $20 billion market cap, for investors to start saying, hey, this is going to be compelling. And plus, I want to see management say, yeah, we're going to deliver real profitability. Not just this phony baloney, stock-based comp, driven free cash flow. So I'm thinking, over the next 5 years, where does the valuation end up? I'm thinking around 25 times, an earnings multiple 5 years out. And so once again, even despite the fact that the stock has gotten absolutely crushed since I called it out last year, effectively saying, hey, it's still not right for me, I still don't think, given an updated outlook for what I think an appropriate multiple is for this business, I still don't think it's crazy compelling. So I think you still see a lower price from here. Where can I be wrong here? I think it's possible. The risk is that you get someone to say, hey, this is the best of breed endpoint security. They're a leader in the space, and they become some sort of acquisition target. So that's sort of the weakness, the counter to my point saying, hey, this could continue to see weakness. Not quite sure who would look to make that acquisition, but I'm looking at this and I'm thinking, even at this price, even after this sell-off, it's still not deeply compelling to me. If you have a different perspective on this, thinking about what's the right multiple, if you think, hey, I'm being too conservative here, I'm welcome to hear it. But the reality is we're in a new world, folks. Like, we're in an environment where you can get 4 or 5%, on short dated bonds. If you're looking at cash, I leave a link below to Interactive Brokers. That's paying close to 3.5%. That's going to go to 4 closer when I presume it'll go closer to 4 if the Fed keeps raising rates. So you're getting over 3% with cash, once again at Interactive Brokers. So like, you have this sort of setup where it's like, the dynamic's different. We are not in a zero rate environment anymore. There's a real opportunity cost of capital. There's starting to be a real opportunity cost of capital. So I think you're going to see lower valuation multiples. And if there's a truly recessionary impacts, I think that's also going to hurt the growth and potential multiples again. So I just look at this and I think potentially more pain to come despite being an exceptional business. Love to hear your thoughts. If you enjoyed this video, if you learned something, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for tuning into Unrivaled Investing.